So I'm really excited to be bringing you guys this story. We're diving deep into the numbers unlike anything we've ever done before, and specifically what this story is 16 units, 87,000 a unit, and we're talking 90,000 net operating income. Let's get into it.
Hey guys, my name is Fraser Nybo. I'm an investor in Saskatoon. We've had properties across Canada. I started investing about 10 years ago, and we've grown our portfolio from one door up to, I think we're up to about 20 doors now. I'm going up to, I want 100 doors by the end of 2020. So we'll see. So follow along for that journey. And then we also have a flipping business. So I wholesale and flip properties. And yeah, I'd love for you guys to follow us on our journey. It's me and my wife, and yeah, we love what we do. There was a lot of learning in it, and it was awesome. We had a lot of fun when we did it. And every deal is going to be different. Like if this was a 100-unit building, it would have been a lot less than 2.5%. I'm a huge advocate for taking your time and really learning the ins and outs of everything you do and building out the foundation so that you can just springboard from there.
What is up, YouTube? Matt McKeever here, and in today's video we catch up with Fraser Nybo. Now, if you haven't been around long on the channel, I'll forgive you for not knowing who Fraser is, but last time he was on the channel we caught up with him in Saskatoon where he was looking at buying a 16-unit apartment building. This was going to be his first foray into apartment buildings, and he was generous enough to share with us the exact corporate structure breakdown and how he was raising the money in order to actually pull off his first multi-million-dollar real estate deal that also happened to be a 16-unit apartment building. Now, it's a lot of fun from my perspective, especially because I remember being a brand new investor and I would have literally killed for the advice that Fraser gave us in the last video. And in today's video, it's really no different. Fraser really dives deep into some of the struggles he had closing that deal, but he did pull it off. So if you want to learn how someone in their 30s is able to structure a deal and actually buy a large apartment building, not using all of their own money, well, this is the exact video you've been waiting for. Smash that like button, hit the subscribe button if you're new to my channel. Let's dive into Fraser Nybo buying his first apartment building. What is up, YouTube? Matt McKeever here. I'm really excited for today's video where we get to catch up with Fraser Nybo. Hey Fraser, how's it going?
Good. How's it going, everybody?
Good. And so if you guys haven't seen Fraser on the YouTube channel in the past, last time I was out in Saskatoon, he actually gave us a tour of the city, caught up with him, checked out a few of his flip projects, and we were also looking at a 16-unit building that he was just kind of putting the final touches on, putting together the deal. So it's been, I don't know now, like a year, maybe a year and a half since we've spoken, Fraser. So I'm really excited to find out how that 16-unit apartment building went and how that deal all evolved. And I know that the audience back in 2019 absolutely loved how you dived deep into the details of how you were structuring the deal. So we'd love any updates on how the deal ended up being structured or if there was any changes to plan as well.
Yeah, definitely. There was actually a lot of changes to that deal. So as you guys know, that was one of our first deals, and there was a lot of learning in it, and it was awesome. We had a lot of fun when we did it. But yeah, so we ended up having it structured where we basically split it up between two investors, and then we had a vendor take back for 100,000. So it was 3 people for 100,000 each. The old previous owners being one of the investors essentially. And then just with the financing that we did, we needed a lower down payment. So we actually, essentially our company raised the other 100,000 because we wanted to bring in 400,000 for a total. And with that, we were giving away 18.75% per 100,000. So with that, we actually had the vendor take back fall through. So there's a good lesson right off the bat. Get that stuff on paper right away. There was actually health issues with the old owners. So I'm not saying I would have made them commit to it if I had it on paper or not. I probably would have let them go. But it's just nice to be in control of stuff like that when you can be, just so that there's not any last minute changes, kind of like what we had to deal with. So essentially what we had to do is I was lucky, one of my partners actually had a friend who was interested in getting in on this particular deal. So he had 100,000 that he was looking to invest. So he actually came in right away. But with that arose another scenario. So because we had, what did we had? It was over 50%. We were starting out at about 60%. So we brought another investor in. So that dropped us down to about 42%, or I think it was actually 41 and some. And then because the investor that was already there brought another partner in. We wanted to compensate her, so we gave her another 2.5%. So that dropped us down to it was about 40% roughly. So the problem that arose with that now is when you do CMHC financing, there's a stipulation in there that for guaranteeing the loan, and a lot of people don't know this, and we didn't know this, but when you have the net worth, like we had the net worth, and the net worth needs to be, I believe, 25% of the loan value, not the actual purchase price of the building, just the loan value. So if you have a loan for $1 million, you need a net worth of $250,000. So my wife and I and our company, we had that. We had no problem guaranteeing the loan, but because of our equity position in the building dropped below 50%, now we had to bring in another partner to guarantee the loan with us. So now we got to compensate that partner, whichever partner it is. And actually, we had a tough time finding somebody. The partner who came in last minute actually ended up guaranteeing the loan just because he didn't have any future purchases planned, and there was a little bit of unknown of whether or not it would affect personal credit and buying power, essentially. So yeah, so we ended up at 38.75% of the building, which is still lots, but we had the three partners. So one partner ended up having 21.25%. One partner had the original 18.75%. And I'll back up just a little bit. That first partner with the 21.25, it's because that investor brought another partner in. And then the partner that came in, he helped us guarantee the loan. So he had the 18.75 plus the additional 2.5% for a total of 21.75. And that's a lot of numbers, so I'll actually break that down on a board for you guys.
So here's a little bit of a breakdown on what happened on the 16 units. So in a previous video with Matt, I explained exactly how it was planned, and we hadn't closed at the time. We're actually quite a ways out from closing. So the original plan, maybe check out the link to that video. You can see that we had investor one was going to put $100,000 in. Investor two was going to put $100,000 in for 18.75. Investor three, it was the same thing, and investor four. So we were going to raise $400,000 in capital, and that'll be enough to fund the down payment on the closing. So essentially, what we did is we ended up getting a 89% down payment. So that essentially equated for $100,000. So that chunk, we'll say, is investor one, but that actually went to our company YXL. And then investor three, we actually had a vendor take back on the deal. So that essentially accounted for another $100,000. So we needed to bring in $200,000. So we needed to bring in two investors essentially. So basically how it worked is we ended up with 62.5% of the deal because we were originally giving away 75% of the deal. So the 18.75 and 18.75 that we essentially brought into the deal via creative financing and good debt servicing, it went into extra equity into our company, or for our company essentially. So that being said, that wasn't exactly how it played out. So we ended up running into a problem with the vendor take back. There were some health issues from on the seller's end of things. So number one, we didn't have them tied down in contract, so that's a good lesson there. And I don't know if I would have held them to it or not, but it's nice to have control over it. So basically, we knew we had flexibility in the deal. We had strong partners and a lot of other people that were interested in getting in on the property, so we actually let the vendor take back go. So with that, we essentially had to bring in a third investor for another $100,000. So then you jump over here, and this is it. This is how it worked. This is how it actually played out. So we had the 16 units, and we brought one investor in, the original one, for $100,000. And they got 18.75% of the deal for that. Investor two was the same thing for 18.75% of the deal. Investor three, the new investor that was brought in because that vendor take back fell through, got the exact same. It was $100,000 per 18, and then they got 18.75% of the deal. And then investor four, because of the creative, not the creative financing, but the good debt servicing that we got, essentially accounted for the other $100,000. So that 18.75 went on to the original 25% that our company had for a total of 38.75. So now one thing we ran into actually, it was a pretty good pretty big problem, but it was interesting to learn, and we know for next time. So with that, when you do CMHC financing in Canada, you need to maintain 50% of equity in the building. And if your equity position, this 65% that we owned as a company, drops below 50%, we're now at 38.75 because we had to give this 18.75 away to that additional investor. So now we dropped below the 50% threshold. So now we need to bring in an additional guarantor. So the way guaranteeing a loan works with most financial institutions and CMHC, their particular parameters are, I think you need 25% of the loan amount as a net worth in your personal portfolio or in your corporation. So on $1 million loan, you need a net worth of $250,000. So this loan was about 1.2 million. And Vanessa and I, my wife, partner in our company, we did have the net worth to cover that. But just because we dropped below that threshold, now we need to bring an additional guarantor to bring us back up over that 50%. So we ended up bringing in investor one. They were willing to guarantee the loan with us. So we gave them an extra 2.5% on top of their original 18.75. So they actually got 21.25% of the building. And now, how did it work? Actually, and then the other investor, they brought in the third investor. So because they brought another partner to the deal, we actually we gave them another 2.5%. So their equity position went to 21.25 also. So now this was, before we gave away that second 2.5, we were up around 40%, a little bit over. So it was slowly eroding the equity position on our end, which isn't a bad thing. Like, I'm happy that it worked out the way it did and we still closed the deal. And maybe it's a good thing that we didn't have 60% of the building in our first unit. The buildings, 1975 buildings, they take a while to turn over, so it wasn't cash flowing right away. Now it's cash flowing nicely. We're getting some really good returns off it. So yeah, still a great buy. It was a great buy in a great area. We know our market, we know our numbers. So but yeah, this is basically how it ended up working out.
And I'm sure one of the questions that the audience is going to immediately have, because they love this nuts and bolts detail. So one, Fraser, really appreciate you always being so open and transparent.
Yeah,
now, when you're looking at compensating a partner for introducing you to a new money partner, or compensating a partner because you had to change the terms and they had to now personally guarantee as well the mortgage, how do you decide what's an appropriate amount? Like 2.5%. Immediately people are going to be like, why 2.5%?
That's a very good question, actually. So I talked with a lot of investors and I just compared other products that were out there, essentially like investment products, I guess. And it just seemed like a good number. It wasn't too high. Like you can't give away 5% for something like that. Even 3% is high. Like it's a $1.4 million building and we're buying it with $300,000 in equity. So it's like we still had to make it worth it for us. And the investors were more than happy at the 2.5%. So to answer your question, I just asked around a lot, saw what other people were doing. And people were doing as low as 1%, upwards of some people were doing 3%. But on this deal, I couldn't have done any more than 2.5. Like I tell lots of people, me and my wife, we run this investment business and we're not greedy people. So we try to give away as much as we can. We want everybody to make money, but like we as a business need to make money to do this also and to continue doing this. So that's where we got that number.
Yeah, I think it's really important that investors understand there's no one perfect way to structure a deal, right? A lot of this is really judgment calls. And I think when it comes down to, what to compensate or what to reward someone for their contribution to the partnership is really about understanding what you really want and need and what they really want and need, and trying to structure a deal that, is fair to everyone or makes everyone equally unhappy, however you kind of want to view that. But when it comes to dividing the pie, I think it's really important to understand what your primary goal is.
Yeah, 100%. And every deal is going to be different. Like if this was a 100-unit building, it would have been a lot less than 2.5%, because 2.5% on a $10 million building is obviously a lot more. So it all varies. It's just a huge sliding scale and there's a million different variables, but you have to do what works best for you and works best for your deal. I agree with you 100% on that.
And so let's talk through when that VTB fell through as well. How far out from closing were you? What sort of timeline did you have? What level, was this DEFCON 5 or DEFCON 1?
Yeah, it was about 3.5 maybe. It was, so we closed on October 1st, and this is probably June or July, probably July. So we had July, August, September. So we had 3 months coming out. But because all that happened, so we already had all the paperwork done with financing, with lawyers. We almost had JVs well, we had them all really like in multiple stages of drafting, or been through multiple rounds of drafting. So you add another person to the aspect of that, and it just makes a lot of changes, and it made it for a lot of change paperwork, from lawyers, accounting, to financing, to everybody. If we had it all, and it actually ended up delaying. I don't think that in particular ended up delaying closing, but we had a long close on that deal. It was like, I want to say 190 days or something. It was extremely long, and a lot had to do because it was CMHC financing, and on a good time, like at a good time, they're like booked up 12 weeks out before they even start making progress on it. So yeah, it was just it was good. I'm a huge advocate for taking your time and really learning the ins and outs of everything you do and building out the foundation so that you can just springboard from there. And we were lucky. We had that deal off market. We didn't have other third party like real estate agents breathing down our necks or anything like that. So it was just me and the seller, and communication's huge. I always told them what was going on. Sometimes I had to explain directly to their lawyer what was going on, but I believe communication's huge, and we made it work. It was
Awesome.
good.
And so now that the dust has settled on that deal, what are the big takeaways or lessons learned? Because correct me if I'm wrong, this was your first real jump into larger multifamilies, a 16-unit purpose-built apartment building. Do you want to get control of your financial life? Do you want to crush it in real estate with wholesaling? Do you want to join my full-time team of wholesalers like Mike? Or Shahir? Or what about Tyler? Or Diego? Or what about Amar? All right, and what do we do, boys?
We make offers, we buy fast. Never gonna miss a deal cause we pay cash. Offers, 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 deals, deals, deals. Tell us, Mr. Seller, what price do you feel? Cause we're Southwestern's biggest source of deals.
Boom! So if you guys want to crush it with wholesaling, you need to join my team. And down below, video description, there's all the links you need. Awesome. Good. And so now that the dust has settled on that deal, what are the big takeaways or lessons learned? Because correct me if I'm wrong, this was your first real jump into larger multifamilies, a 16-unit purpose-built apartment building.
Yeah, 100%. And yeah, there was a lot of stuff. So we took possession, and there was an eviction on day 2. It might have been day 1 actually. And the old owners, they actually dealt with that. They were like, we don't want you to have to deal with an eviction and deal with the sheriff and everybody that goes with that, because there'll be a change of name on the paperwork and it'll confuse people and they'll probably extend the eviction. So they were like, we'll just take care of it. Like I said, it's all a relationship. So they were good about that. So it started off with that, but we got that unit filled right away. And then one huge tip that we're implementing in our business and all future purchases going forward from that point is once you get a building under contract, a multifamily apartment building, you need to have a clause in your contract that states that you get the final say on which tenants are allowed in the building. So you get to vet your own tenants. We didn't do that. And I don't think there was any malicious activities or anything on the seller's part. I think they just genuinely wanted to give us a full building. But over the coming months, there's 5 or 6 tenants that they filled with, they were like month-to-month contracts, low deposits, if any deposits. And those are the tenants that we had problems with. So we ended up having to do a little bit of a turnover. But it was good. It was like once a month we would have one person move. So I think 1 month we had 2 people move, and like we have the building. The building profile was interesting, but we ended up cleaning it up really nicely now, and we have a really, really good building. So
yeah, that's a really important point that you made there, Fraser, that I really want to stress for the viewers. It is usually we find, and feel free to interject here, but we find that until we go firm on the deal, that usually these sellers aren't going to be comfortable with giving us kind of veto power over who comes in or out. But certainly once we go firm, we always try and insert a clause at that point in time. In order to waive conditions, we ask to insert that clause, or we'll write the clause in such that it says once upon, waiving of all other outstanding conditions, that then we're going to be able to decide who moves in. And actually the way we normally actually structure it is we just say they can't fill any vacancies. We'd literally rather it sit vacant. Because we find there's too much back and forth. And like you mentioned, Fraser, sometimes it is people with malintent, but a lot of the times it's just people taking the path of least resistance. And so I find that once they've mentally sold it, they're like, man, just slam some bodies in there, keep it
Yeah.
full so that the new buyer is happy. And, I'm not going to really deal with the consequences. So they're not crossing the T's, dotting the I's when it comes to vetting these tenants, because they know that they're not dealing with them 6 months from now.
Yeah, and that's exactly what we found, and that's exactly what we're implementing in our business. And like you said, I would rather take a empty building to what we ended up taking, because like we had one gang member in there, and like the building was all tagged and stuff like that. So whatever, or not the building, but the unit, and we had whatever a coat of paint, so $800, took care of it. But yeah, just good learning lessons moving forward. And yeah, I'm happy to share those with you guys. It's good for everybody to know, and any problems that people can avoid for, you know what I mean, like problems that we've gone through.
Any other adjustments to, either terms that you would include when purchasing, or any adjustments to your processes? I know for us, one of the ones is, I hate it. We still sometimes do this just because sometimes you have to compromise, but I hate closing right before the first of the month. So I love closing like the 5th or the 7th of the month. So rents are already collected. I'm going to get a rent adjustment on closing, which, one, I already like. It reduces the amount of cash I need to put down when buying the property. But 2, it gives me a couple weeks to just get my sea legs, get my property managers in there so that they can introduce themselves. We can set the new standard for how rent's going to be paid and things of that nature.
Yeah, that's a really good tip to tell people too. And then also one thing to note on that, you can build, if you did it right and you had a big enough building, you can build one huge reserve fund, because financing, like we had possession October 1st. And like you said, moving forward, we'll do the 5th or 6th kind of thing. And then we didn't have our first financing payment or debt service payment come out until December 1st.
Yeah.
So we had October rents come in, November rents come in. And then just because of the maintenance that needed to go into the building, and just like you said, getting your sea legs, we didn't have a huge reserve fund built up right away. So I'll get into that later. But yeah, definitely some other good clauses to put in there.
Awesome. And anything else come to mind, tips for new buyers? One thing I'm a little curious about during the financing process, like, are phase 1 and phase 2 environmentals as popular out in Saskatchewan as they are here? So like, I know, especially during COVID-19 now, you used to sometimes not have to get E1s or E2s, but now you almost have to do on every single building.
Yeah, it's common out here too, especially multifamily commercial or any sort of commercial deal. And this is what I tell people too. Even if you say you were buying cash, or you had a bank that you didn't need to do an enviro with, I would still recommend doing an environmental with, because if you project out 20 years when you're going to sell the building, there was a laundromat there in whatever 1950, or it was removed in 1950, or there was a gas station uphill from you half a kilometer away, or whatever the parameters are, it's gonna catch up to you when you go to sell, and then it's gonna hurt your sale price, because that buyer is gonna actually negotiate with you to do the remediation. Whereas if you even paid cash for a building, or for whatever reason didn't have to do an enviro, like I said, I recommend doing an enviro, because if you do catch something, it's gonna help you. Like it's $3,500 or whatever it is. Like I don't know what they charge out east, but
yeah, about that for the E1, and then I think E2 is like 14, maybe 16.
Yeah, it really jumps. And then, but yeah, either way, you can work that into your price, and it'll help you in your negotiations. And the sellers have to take care of it, so you have peace of mind when you go to sell X amount of years from now.
Yeah, and one thing that I just want to point out too, Fraser mentioned that he closed on the 1st of the month, and I'd be curious how your lawyers handled it. But I've closed on the 1st of the month, where I assumed that the old landlord had to collect rent, but my lawyer and their lawyer told me it ended up actually having to be me collect rent. So literally from that day, for that closing forward, I was like, never again will I close on the 1st or even the 2nd. I want to make it very clear that I want essentially a free month of not having to chase tenants. So did you have to collect rents on an October 1st closing?
No, actually, the old owners collected them. It was just business as usual. All the tenants sent the rent.
Oh, nice.
And I think there was a couple people that were late, but it just got transferred over to our third-party property management that we hired. I think they paid on the 12th or something like that. So, but no, so I haven't been stuck on that yet. But it is definitely, you do enough deals, you're going to get caught on that for sure. So. I've had property for about a decade now, and I've been doing a lot of my own property management. And that doesn't mean I go and do toilets and stuff anymore, even though I did lots of toilets back in the day. Definitely do your research. That's number one. And then number two, make sure that everybody's rules or everybody's jobs and everything are laid out very clear. Just ask the direct questions. Don't be afraid to ask questions and ask like flat out, how much does this cost?
Thanks again to Fraser for taking the time to break down in such details what's going on with his first large apartment building. Smash that like button if you got value. Hit the subscribe button if you're new to my channel. But also, if you didn't notice, this is actually a two-part series. So we had so much great information and such a great conversation with Fraser, we decided to turn this into a two-parter. So in the second part, we're going to dive even deeper into the structure he used to raise money, as well as some of the rules he uses when it comes to deciding whether to do a deal or not. Again, this is the behind the curtains that I don't think a lot of people are sharing on their real estate content. So if you guys enjoyed this, what I really need from you is some support in the comment section and a reminder that sharing is caring. Otherwise, if you want to see the first video we did with Fraser, check it out right here, or check out this entire playlist of videos we did with Fraser, especially if you're in Saskatchewan. He's an amazing mentor.